Good morning, everybody. Thank you, Gary. It's a pleasure to be here. As Gary mentioned, I have the honor of overseeing Marcus & Millichap as an organization. We're proud of nearly 2,000 investment sales specialists, and particularly proud of our Marcus & Millichap Capital Corporation financing specialists, which are approximately 100 strong, covering all spectrums of capital market services, advisory services, and debt and equity placement. And that is one of the fastest, if not the fastest, segment of our company. And we're very proud of the work that MMCC has done for our clients. Part of my job today is to kind of step back, share some perspective with you from a CEO vantage point of both running an organization, having come through the last 18 months or so, and also talk about the markets and, of course, investment strategy, lending strategy, and so on. Let me first start by saying that this is my first large-scale in-person event. I haven't been with this many people in person since the pandemic began, and I can't tell you how wonderful it is just to be out with our clients and our lender partners and our own team. It is remarkable to see the release of pent-up demand that's been a theoretical number on a piece of paper for a long time now actually come to fruition. And that's one of the key things that I think we can't overlook in what we're experiencing. We've come through an incredibly difficult and hopefully once in a 100-year type of a crisis. But on the other end of it, as the former Fed chief, Dr. Bernanke, shared with our clients on a webcast last year, should be a roaring 20s style period of economic prosperity and growth. And I think we're experiencing that right now. So today I'm going to share some of that macro to more micro investment strategy perspective with you, and then talk about some of the reasons why the outlook even beyond the next 12 to 18 months seems to be as good as it's ever been. So starting out on the macroeconomic front, just to give you a quick read on the key ingredients that I track, both in running our organization and advising our clients. On the left, you have this V-shaped, incredible trend of having wiped out 22 million jobs in 2 months. Took us 10 years to create 22 million jobs. We wiped them out in 60 days, essentially. And then, of course, coming back, we've now recouped 17 million of the 22 million jobs that had been lost during the worst of the pandemic. And if you look at the corresponding rebound in retail sales, we are still a consumption-driven economy. A consumer accounts for more than 70% of our economic output. So retail sales, as you can see, are now well ahead of where they were pre-pandemic. And the release of pent-up demand that I just referred to, with all of us being here for the first time at a large-scale in-person event, as an illustration of the $4.8 trillion of unspent money that is sitting, waiting to fund life going back to normal. And we're beginning to see, of course, some of that happen. Think about that. We have essentially a $20 trillion economy when you have $4.8 trillion of excess capital, excess cash that was not in circulation because of the lockdowns and the health crisis, now ready to come back into the economy. That is inherently going to create a roaring 20s style period of economic prosperity. But it also has some side effects. Before we talk about the side effects, let's talk about how we basically got here. Going back to the period of March, April of last year, as I was preparing my first webcast, with many of you as audience members, we have a very significant client base that counts on our webcasts and market forecasts to think about what they're doing with their strategy. And I was getting all kinds of questions, of course, just weeks into the lockdown about forecasting what's going to happen, which was impossible. Nobody knew exactly what was going to happen. So after several days of really thinking it through, I diagrammed for myself what had happened in the 08-09 crisis and what was happening at that time for us now in the pandemic. And that really crystallized something very, very important. 08-09 being the most recent crisis that we can all relate to, of course. The 08-09 crisis was caused by a sick banking system, by a sick credit system that basically spread. How we got to that sickness was over-speculation, over-leveraging, and you all know that, particularly on single-family houses. But the fact that the system itself was hit very, very hard internally because of a sick credit and banking system that did not have a lot of liquidity, which then spilled over to the rest of the economy. And secondarily, the response to that, because there had been no playbook, because there had been no previous cycle like '08 or '09, took 13 months to basically come to fruition. TARP, which was the largest stimulus package, came 13 months into the first signs of the Great Recession. 13 months, over a year. And it accounted for about 6.5% of our GDP. 6.5%. Fast forward to what we were experiencing in March, April of last year, and it was not a sick economy. It was not a sick banking system. It was not a problem of illiquidity. It was a problem of a pandemic, which led to a forced economic shutdown. So the conclusion became fairly clear that governments around the world are going to flood the system with liquidity. They're going to take all kinds of measures to counterbalance and fight the effect of a forced closure. And that's exactly what happened. So if you look at the money supply chart here, is unprecedented amount of liquidity that has been injected into the system, not just in the United States, but around the world. That equated, for us anyway, to roughly 25% of GDP. So this notion of a swift response, having come in 7 weeks versus 13 months, and 25% of GDP versus 6, is the underpinning of everything we're experiencing today and will for the next at least 12 to 18 months, until all of that basically washes through. So it's really important to keep that in mind. There's a reason I'm getting more calls from great long-term loyal clients, more calls in the last 90 days, very upset with us because they're coming in second in the best and final bids for assets, because there's just so much capital chasing real estate. And of course, that is a function of low interest rates and the liquidity I'm talking about. So let's not forget why we're here, how we got here, and therefore how do we navigate through this marketplace? Well, inflation, Mary touched on it. A lot of people are saying it's not a problem, it's transitory. I think a lot of it is transitory. You look at these charts. The left is PCE, the personal consumption expenditures, which is the Fed's favorite way of looking at inflation. And it is off the charts. And part of that is the release of pent-up demand, and supply chain issues, and all the things related to the global economic shutdown. That is true. However, when you get the kind of growth we're experiencing, which I believe is going to be sustainable, maybe not at the current white-hot rate that we're experiencing, even with some cooling, even with somewhat of a kind of soft landing after the initial boom, there's going to be inflationary pressure in the system. And so interest rates, especially the Fed stance, hasn't shifted yet. They can't afford to tamper with the recovery just yet. And from a 10-year Treasury perspective, you've seen rates go up and pull back down because of the another round of the variant and partial closures and the slowdown in the economy. You saw it in the job numbers. Last month's job numbers really showed the Delta variant effect. So we're not out of the woods. We're going to see these choppy kind of trend lines as we work our way out of this pandemic. The point is, inflation is a factor. A year from now, my expectation is that we'll be having serious discussions about the Fed having to become more aggressive, sweep up the excess liquidity, and make sure inflation doesn't become a problem, which itself would be yet kind of a new problem to have. All of this is correlated with the vaccinations. Of course, as sooner we get the health crisis behind us, the better. You can see the trend lines with the vaccinations and the economic improvement and so on. We're not really out of the woods yet. Everything is still hampered to some extent. So we still have, the good news of that is that we still have more of this pent-up demand that's going to get released down the line because it is getting somewhat interrupted at this point. So not to be too redundant with some of the information that Mary shared with you, but I do want to give you our perspective, taking this macro overview into the transaction markets and how, at least the way that we're seeing the markets, investors are taking advantage of opportunities in the marketplace. This chart is just trading activity, just volume of trading activity. And the orange lines are second quarters of each of the years that are shown. And you can see the second quarter of this year was at a very robust pace, if not a record, for a second quarter. Trading is back. All this capital that's been on the sideline is trying to come into the marketplace. A lot of reluctant sellers have now become much more willing to sell because of what's happening with pricing. Concerns over tax law changes are adding to that motivation. They're not the only motivation. I get the question a lot, are people selling because they're really fearful of the tax law changes? I don't think so. Most of our surveys show that it's a factor, but it's not the driving factor. And here's what I call the fan of impact. Here's how we see the marketplace having been affected by the pandemic. From left to right, green to red, essentially the least impacted and the best performing on the fundamental side are the green and the light green on the left, all the way to the red on the right. So life sciences, of course, single tenant retail, fast food restaurants, 50 to 70% of your revenue coming through drive-through was almost designed for a pandemic. Put on top of that all the delivery services that have popped up that are basically supporting that revenue growth on the fast food side of the equation. Necessity retail, discount retail, having done extremely well. And of course, warehouse distribution, Mary talked about it a lot, manufactured and affordable housing. Manufactured housing has been on fire. Our division in that segment has just done tremendously well over the last 18 months, and they're still as active as they were even a year ago, if you can find the inventory. All the way through to hospitality, lower tier shopping centers, seniors housing. And what's amazing about this is that this is the menu for everyone. If you're risk averse, yield oriented, cash flow oriented, as most of our clients are on the private client side, who are in apartments, single tenant net lease, and so on, the left side is absolutely the place to be. And if you're obviously a much more higher risk, higher reward oriented entrepreneurial investor with retail turnaround investments, the reuse of retail, what's happening with hospitality, which really tells us that capital is coming in ahead of the fundamentals improving, because the fundamentals have improved some, but now there is disruption again because of the Delta variant. But the faith in hospitality is there. Pull back in new construction, and then everything in between. The point about this is that there's been no time like the present with the combination of this sort of menu plus low interest rates plus the liquidity and an economic expansion that's sustainable. Those spell a pretty nice mix of what to expect for commercial real estate in a global capital markets environment. Just a quick summary of what we're seeing on the fundamental side of the equation. Save for office and seniors housing and hospitality, which has recovered some but has a ways to go, every other property type is showing very rapid recovery. And for office and seniors housing, there's just a lot of murkiness, a lot of debate. Mary touched on it, so I'm not going to go into a lot of detail on that. But here's the challenge. Look at the pricing. And when you look at the face of this pricing trend, everyone starts talking about bubbles. And everyone starts getting concerned about bubbles. And that's actually appropriate. We've been here before. But I think that the most important thing underlying some of these numbers, apartment prices since '05 are up 63% on average, if you can't see the chart. Hospitality right now is minus 7%, but that's somewhat understandable. Office is up 25%. Single-tenant retail is up 30%. Multi-tenant retail is up 23%. Multi-tenant retail prices are up 23% over '05 levels. And industrial is up 58%, understandably, and self-storage is up nearly 40%. When you look at these numbers, the concern is valid. But if you look at the rent growth and the occupancies and interest rates being calculated into all this, actually, there is very little, if any, bubble. There are pockets of overheated markets. But it really begs the question, are these prices all that outlandish when you factor in the occupancies, the rent growth, the low interest rates, and the prospects of what's ahead in the next, let's say, 18 to 36 months? And it's a whole different picture. Here's how we're seeing cap rates kind of evolve. And save for office and seniors housing, this chart kind of shows you the indication of downward pressure on cap rates or upward pressure on cap rates and the range for each property type. We're seeing downward pressure on cap rates across the board. And those buyers who are stepping up and frustrating some of our best clients who are doing the math and the logic for some deals, ultimately runs out, are counting on record rent growth to justify a 3 cap for an apartment building. And when you factor in 2-3 years of exceptional rent growth, that 3 cap is not really a 3 cap. And of course, you have to look at the supply and the submarket and all that, which is exactly what we do to help our clients make sure they're not making mistakes. But it starts to make more sense than just capital being, irresponsible or being completely speculative. So beyond all this, taking another step back, what else is driving our business? What else spells risk and opportunity? Again, Mary touched on it real quickly, but I wanted to elaborate. Our demographics are changing extremely fast. Over the last 10 years in presentations like this, I constantly touted the incredible growth in the young adult population as millennials were coming through the system. And so the 20 to 34 age cohort on the left showed tremendous growth 10 years ago. They've gone through that growth, and more than 60% of millennials are now in their 30s. And they're moving away from downtown areas, going into the suburbs, getting married and starting families. 60% of millennials are in their 30s. That's a very different picture today than it was even 5 years ago. So when you look ahead another 5 years, we're actually looking at a 1.7 million reduction in the population of 18 to 34-year-olds in the United States, while the middle segment of 35 to 54 is growing by 7.2 million. Those younger millennials that were coming through back then are now coming through into their 30s. And so they have more income, more spending power, they're forming families, they're buying homes in suburbs, and then the pandemic comes along. This is all pre-pandemic. The pandemic comes along and puts a rocket booster in a lot of those trends and hurts downtown areas. I agree with Mary. I'm a big believer that urban America will come back, and we're already beginning to see signs of it. It's going to take a while. We have crime issues, homelessness issues, and all kinds of other reasons to attract people back to downtowns. But over the next, I think, 3 to 5 years, that's going to work itself out, and there will be some opportunities there. Lastly, on this chart, look at the right side of this chart. Something like 10,000 people a day are turning 65. 10,000 people a day are turning 65. Today, 10,000 people will turn 65 in the United States. And that's an incredible aging of the population. We're seeing it in Japan, Western Europe, and other places in the world. And this tremendous wave of older Americans, 11.5 million more of them in the next few years than we have today, is a profound impact on not just property use, forget the space usage part of it and demands for different real estate. Think about the wealth, and I'll talk about that in a moment. The wealth effect, the spending power that is going to be unleashed. And lastly, what I want to say is that, what I want to share with you, the United States is the only country in the Western world where 10,000 people a day are also turning 21. So not only do we have 10,000 people a day turning 65, we also have 10,000 people a day turning 21. So the dichotomy of that is an incredible positive wave of spending power, different uses of real estate and different investment strategies, more and more toward safety, more and more toward the cash flow type of investment. But at the same time, given the wealth effect, more and more entrepreneurial, high risk, high return, let's buy a shopping center, let's pool some capital and do a turnaround and reap tremendous results. The expectation over the next few decades is that $68 trillion of wealth is going to be transferred from baby boomers, who were 80 million plus strong, to their kids. Millennials were just as big, almost 80 million, and future generations. That wealth transfer in the United States is a massive tidal wave of demand for investments. A lot of the children of our long-term clients that Marcus and Millichap grew up with, we're turning 50 this year. We're very proud to celebrate 50 years in business. I can't tell you how many of our clients have been with us for 30 years, 40 years, 25 years, bought a tiny little 5-unit deal 30 years ago and exchanged it and traded it, and now they're sitting on an incredible amount of real estate wealth for their families. We're so proud of that parallel relationship with our clients. And we're now actively discussing plans with the kids of those clients that we've grown up with. And those kids, a lot of those kids don't want the real estate. They're educated, very astute, they're very well informed, and they are our new client. Much, much more sophisticated, which speaks to the sophistication of our business and the need for every advisor in our firm and anywhere else to be so much more proficient at analysis, understanding markets, capital markets, supply, demand, and all that. This change is profound. A lot of this wealth is not in real estate. Let's talk about that for a moment, and I'll show you where I think the demand is going to come from. But the parallels between the aging of the population and what happens in commercial real estate is illustrated on this chart. You look at the aging of the population, the 55 plus that I shared with you a minute ago on the left, happening while, look at the transaction velocity of single tenant net leases over the past 10 or 15 years or so. Interest rates have gone up, they've come down in the middle of that cycle. The capital flow into single tenant net lease, because of its low maintenance, cash flow oriented nature, is tremendous, and it's here to stay because aging investors want less headaches and more of a solid return on a cash flow basis. So if you look at the institutional marketplace, what's remarkable to me in a global environment, institutions are allocating 11% of their total assets under management to commercial real estate. Now that's up from 8.9% in 2013, you can see it on this chart, but it's only 11%, 11%. If you look at pension funds that are currently managing $32 trillion, less than 5% of that is in commercial real estate. And who's their client? It's essentially teachers, firemen, government workers, private investors, average Americans. They need yield in a yield-hungry world. I think that's going to attract more institutional capital to real estate. If you look at the private client business, we're very proud that 70% plus of our client base are truly private investors, individual high net worth investors, small partnerships, family offices, and 30% of our business is done with what you would consider major investors or institutions. As the private client broker, I can tell you that the new formation of capital, new partnerships that are coming in, the 30-somethings I meet at conferences like this that are raising money with friends and family that are excited about investing in commercial real estate is so inspiring. And I can tell you right now, if you look at the U.S. households as a whole, I mean, we have a 65% home ownership, 65% basically own their homes, 22% are invested in stocks, whether directly or through mutual funds, and less than 10% of U.S. households currently hold any other real estate investment, rental homes or commercial real estate. If you look at the high net worth households, those that have an estimated net worth of $500,000 or more, there are 28 million of those households. 74% of them are not invested in commercial real estate. So the capital demand for our asset class is going to build tremendously. The market right now feels like secondary and tertiary markets is the place to be. I think that's here to stay. That was happening before the pandemic. If you look at where people are counting on growth, I mean, look at these markets. These are the darling markets on everyone's favorite list. Seattle, Salt Lake City, Las Vegas, Phoenix, Denver, Texas, basically, Nashville, Atlanta, Charlotte, and all over Florida. This is where the competition is so strong right now, so hot right now. But if you look at secondary and tertiary markets, well before the pandemic, the volume of capital going into the secondary and tertiary markets has been growing for many years. It's up 60%. Or, I'm sorry, it is making up 60% of the capital going in to commercial real estate. 60 or 59, almost 60% of it is now going into secondary and tertiary markets. And the good news is the cap rate spread is still there. It's getting very, very tight. Nowhere near as tight as it was in the heat of the 06, 07 pre-crisis, where everyone threw discipline out the door and cap rates basically converged. I hope we don't get to that point because there has to be some discipline in the marketplace. There's still some room, some spread, but it's getting very, very tight. And lastly, what I want to share with you is a chart I've always used as a reality check for commercial real estate investments and concerns of bubbles and what have you. and that is the spread between interest rates and cap rates. And if you look at the 490 basis point spread today, and look back at all the periods where the spread was high, going back to 1990, whether it was the early 90s, whether it was the early 2000s after the 2000-2001 recession, and the 9/11 tragedies, which is almost 20 years ago, hard to believe, and after the financial crisis, where the spread was 580 basis points, it's very similar to all of those periods. And who wouldn't want to go back to those periods and put more capital to work through commercial real estate? So with that, thank you very much for sharing your time with me. On behalf of everyone at Marcus & Millichap and Marcus & Millichap Capital Corporation, we're very proud to serve your needs. We're here. We have a large presence here at this conference. And thanks for having us as a part of this great program.
All right, you want to have some fun?
Let's have some fun.
All right, so we're going to spend a few minutes and talk about a few other things that Hessam did not cover in his presentation, or maybe he did, and we'll elaborate on those a little bit. And then I'd like to leave it maybe 5 minutes or so at the end for Q&A or longer if you guys have some questions. So,
just as a reminder, again, you asked me, I'm not going to talk about Britney Spears' conservatorship. I mean, that's off limits, all right?
Fair enough. You gave a great overview of kind of what's going on in the markets, but maybe we could step up just a little bit and talk about more global. So the current administration has proposed a number of changes, raising the corporate income tax rate, for example, and potentially more regulation. That's likely going to make U.S. corporations less competitive on a global stage. How do you see that all playing out? How do you see that, is it going to happen, number one? And number two, how can they position themselves to compete on a global stage that's becoming ever more competitive?
Well, that's an incredibly important question, something we think about all the time. I try to keep up in my reading to really understand all the moving parts of that. First of all, realism. The administration has so much on its agenda.
Correct.
And they have thrown so many things on the table that I think it's going to take time to get through so much of it. Mm-hmm. And so I hear so much speculation in the areas that are directly related to commercial real estate, whether it's tax reform, the 1031 exchange provision. Capital gains, of course. And there is way too much speculation. We really don't know where it's going to end up.
Right.
And people are so eager to conclude because they're frustrated that it's taken this long. Net, my personal expectation, has no data backing or inside information or anything other than just logic and having, as you have been through many cycles, I've been through many cycles. A lot of the proposals don't come to fruition. Yeah, I shouldn't age the two of us, but anyway. And I think there's going to be some reasonableness from the proposed levels of, let's say, the capital gains tax rate. The notion that the capital gains should be at the same rate as ordinary income is pretty drastic. And my expectation is that it's not going to end up anywhere near that. And so I think we will have higher taxes. There's going to be higher taxes, but I think the economy is so strong, and that pent-up demand I talked about is so strong, and the underpinnings of the demographics are so strong, and you have to really hand it to America and the American spirit in that we reinvent all the time. Look at how retail is reinventing itself so fast. Look at the fact that new business startups in the U.S. started to set new records in July of last year. July of last year, in the middle of the pandemic, when at the time you had record layoffs and furloughs and people were trying to figure out how to survive. And that entrepreneurship is kicking in with new business formation applications. Fast forward a year from now, we can't find qualified workers. We have something like 10 million open jobs to 6 million people looking for work. Yeah. Where's the mismatch? Yeah. It's the skill set. So I think we're going to be in fine shape in a 2 to 4 year outlook. I worry more about inflation getting out of hand and the Fed having to get real tough on that to basically kill the momentum than I do the taxation side. Related to corporate America, I really do believe that there has to be more done on an even playing field because the U.S. has been at a disadvantage over a lot of its trading partners. The U.S. has had higher corporate taxes than a lot of other countries. And the U.S. has carried the burden of defense for a lot of our friends around the world,
Right.
which costs us a lot. And so evening a lot of that out, I think, is an absolute essential. I don't know if this administration is going to get to that. The proposed minimum corporate tax rate at a global level, I think, is a good start. Whether that'll fly or not, we'll see.
Well, there has been downward pressure on that. I mean, they wanted to do what, 25?
Yeah, right.
And now the number is, a little south of that.
Right.
We'll see.
Somewhere between 15 to 20%.
20, 21, yeah.
The last one that I read. But I don't think any of that is going to hinder this cycle we're entering for the economy and for commercial real estate.
Interesting. You touched on the amount of capital that's either come into the market looking to invest in commercial real estate, or sitting on the sidelines, and maybe it can't get access, right? Because it's getting outbid at, based on what you've said from some of your clients. Where can, with all that capital there, where are the opportunities for investors today? I mean, do you have to kind of take a step down and say, I'm going to go into secondary markets, I'm going to go into tertiary markets because there's a better, delta there on the returns? Where do you see the opportunities for an investor, either that's coming into the market or that's sitting on the sidelines, can't get capital deployed in their core asset classes or core markets they want to be in? Where else should they be looking? Whether that's
Sure.
on an asset class basis or a locational basis or both.
Well, I think your point is right on, as illustrated by a chart I just shared, that so much of the capital has been going to secondary and tertiary markets. And that's more justified in this era than it was, let's say, 20 years ago, when it was just, well, I can't find the yield I'm looking for in a primary market, decent class or decent quality asset class, so let's go over to Tucson. Oh, their yields are higher, and I'm going to speculate on that. That was a lot more risky 20 years ago than it is today, because the job growth trend is becoming a lot more broad. And you're seeing things like e-commerce bring prosperity to a lot of different places and reinvent, warehouse distribution and the back office world, the biotech world, all the different components of the economy, electric cars, that are reinventing themselves, are feeding job growth in all kinds of places.
Right.
Much more so than ever before. So that's really promising. But to me, as I go around, I was just in Boston, spend a few days in Boston, spend a few days in Washington, D.C. Anytime I go visit a market where I have a little bit of time, I go out and I just drive.
Sure.
Different markets and different sub-markets. I can tell you universally, my view on the best strategy for commercial real estate, wealth creation, value creation, is still value add. Because there's so much older, not quite obsolete, but really tired real estate around the country. And it's becoming so hard to add new supply. Land costs, labor costs, materials costs,
yeah.
All the volatility. And as long as you don't over-improve an asset, we tend, as an industry, we tend to reimagine a piece of real estate and get really excited about it, and then over-improve the heck out of it above and beyond what the trade area, economics, demographics can really afford. That aligned value add with the local trade area and the regentrification, now not just of urban America, now we're seeing regentrification in all kinds of pockets.
Right.
And the mixed use wave that's affecting, whether it's suburbia, whether it's, urban America, or what we call it the Gerban product, which is, garden urban mix somewhere along the way.
I haven't heard that phrase yet.
I just invented it.
I love it.
I think that's where the play is, because we have to reimagine commercial real estate. We're not sitting here in 1960 where you could add a lot of product like we could.
Right.
And so the density forces us to have to reimagine real estate. Some of the stories of what is happening with shopping centers with complete reuse, becoming corporate campuses or industrial or medical or educational facilities, is a great example of that.
So it's really across the board. It's not just value add multifamily. It's everything. It's office. It's industrial.
Exactly.
It's creative, reuse for old malls, for example.
Exactly. Or even just a tired office building.
Right.
How do you bring it up to date without overspending?
Right.
That's the key. And then one of the greatest quotes I heard from a dear friend and a great client of ours, Dan Horowitz, who used to run DDR, the retail REIT. He was on one of our panels, and he said, retail, for example, is not overbuilt. It's just under-demolished. That's kind of what I'm talking about.
Yeah. No, look, it has been amazing to me to see how creative to use that word, developers have gotten with malls and what they've done.
Right.
You know, whether it's converting them to self-storage or converting them to more lifestyle centers versus an enclosed mall, for example. I mean, it's, you know, and you're going to have to get creative, or you're going to have to scrape them, and there's going to be, you know, probably a lot of both.
Yep. So can I go off script for a second?
For sure.
So I'm going to ask you a question. This is totally unprepared. We had a great dinner last night. I really enjoyed spending time with you. And you made some great observations and comments about your love for starting businesses, growing businesses, and the fact that your focus now in life is to pay it forward.
Yeah.
And I think for all of us in this room, that is such an important responsibility in that we're not just creating investment companies or we're not just lenders or participants in this great industry. There is a way to make sure future generations make this industry even better than it's been. So I want to ask you to share with the audience what you shared with me.
Yeah, no, that's a great question. So, yeah, look, I got into this business 35 years ago through the kindness of a gentleman that I was sailing with. That was the connection, and it's been great, right? But to me, having gone through the career and having somebody help me get into the business, right, and now being fortunate enough to have started, built, and expanded businesses and hiring people, especially younger people that are new to the business, right? They've been in the business maybe less than 5 years. Given the fact I am on the downside of my career, right, which is one of the reasons, you know, not that I'm on the downside of career, but I mean, one of the reasons that I was honored to be part of California Mortgage Bankers and get on the board was to try to give back, right, was to try to give back to the industry that's been so good to me and my family, but also to help the people that are new in the business, you know, the 20s and 30-year-olds that are coming up in the business, and try to impart, you know, some of the things that I've learned through, you know, 6 or 7 or 8 cycles. Because there's good experiences and there's bad experiences, but they're all experiences that you can draw from as you build a business or as you know, attack a problem in a different way. You can use those experiences from the past to hopefully solve that problem of today.
Absolutely.
So, yeah, I mean, you know, whether it's mentorship, whether it's, you know, hiring people and giving them an opportunity, whether it's, you know, volunteering for a great organization like California Mortgage Bankers Association, yeah, and look, many years ago when I stepped out of you know, doing production to get into management to try to, you know, again, build businesses, it was to a large degree because I wanted to help build businesses, but I also wanted to help kind of the next generation in this business. Because look, this is a great business. I mean, we've all benefited from being in this business, and so yeah, the more I can give back in various ways, whether it's directly or indirectly, that's kind of where my head's at today, and I have been, you know, very blessed and very successful so far in building these businesses and hiring a bunch of great people and seeing them kind of progress up through the business. You know, I look back of, you know, guys that were my runners, you know, when I was in the business. Nick Alston, where are you? You know, who've become very successful in their own right, and that's very gratifying to me. So I think, yeah, we need to do that as an industry. We need to do that. We need to have more mentorships and mentor programs to help the next generation in the business. Right. So hopefully that answers your question.
No, it's great. I was inspired by your comments. I wanted to make sure that everyone else hears about it, because it's the perfect way. It resonated with me because I'm seeing that the talent that's coming out of real estate schools and finance schools in general around the country, the universities that I go to either give a talk or you know, have a sponsorship with, is tremendous. The talent is so advanced from anything I've ever seen before in terms of their education, technology, knowledge, and all that. And I can't wait to see what they'll do to the industry.
Yeah.
Because they're going to change it in their own way.
For sure. And I'll flip it around to you. So does Marks and Millichap do something like that? Do they have a program for kind of up-and-comers?
Absolutely.
Yeah, that's
we
great.
have a variety of programs. We have a basic mentorship for people who are interested in the business, where we assign them to one of our senior agents. They're the best teachers in the business. We have a formal training program that the company provides through our regional managers. One of the things that's different about our model is that we do have regional managers, all of whom have been investment salespeople in their career. So they know the business really well,
right,
and they're really good trainers. And so that's how we scale our training. And then we have a lot of, you know, virtual electronic training programs. But more important than any of that is to really teach a client service orientation. You know, you can always learn the math, you can always run the modeling, you can always run the, you know, research side of submarkets and neighborhood. It's the client relationship.
It is.
It's the service delivery. that has been such an important part of our culture and our brand, that is more about our training than anything
Well,
else.
look, this has always been a relationship business. I mean, one of the big downsides of COVID is we weren't able to interact with people.
Still,
right?
still the case.
Yeah, you can't
Still
go
the
see
case.
clients.
Right.
You can only do so much virtually. But yeah, the relationship is key, right?
Exactly.
Sitting next to somebody and sharing information
Yeah,
and thoughts is you can't do that on a Zoom call, in my opinion.
You're absolutely right. I've shaken more hands this morning than I have in the last year. It feels great.
Yeah. We've got about 5 minutes, so I'm going to open it up to some questions for Hessam. If anybody's got any, come on, don't be shy. Yes, sir. You could step up to the mic if you could, just to. Okay. Have at it.
I'll repeat the question. Go ahead. Great question. The question basically is something like this. As we're seeing more and more reuse and reimagination of real estate from an investment strategy, what kind of metrics are we looking at on the appraisal side and on the lending side so that capital can be provided to facilitate this repositioning of commercial real estate? It's a great question because it's been a challenge. A lot of times when you're doing a complete reuse, it's very hard to quantify the future demand. The good news is that in most of the cases, the vision for what the real estate should be or could be and the capital required to make it happen has had a large component of the sponsor's own money. And so they're putting their skin in the game. They're raising money from credible capital sources. Lenders are very sensitive to see where the money's coming from and who the sponsor is and what their staying power is. And then on top of that, if they're using firms like ours, who have with an extensive research department, and a lot of our peers have great research departments too, in really formally studying the trade area and the highest and best use as related to what they want to reimagine the real estate to be. If you couple the quality of the capital and the amount of capital that's coming in from the sponsor, where it's not just a roll of the dice, somebody's getting a fee, somebody's getting maybe a quick exit, and they're not really in it for the long term. It's a different ballgame than somebody who's really believing in the real estate and putting some capital into it. I think that has been the deciding factor in the kind of lender that's willing to lend at a reasonable cost. I mean, you can always find money, right? Money's just money. It's just a matter of the cost of that money. But thanks for asking the question, because it's challenging the appraisal side quite a bit. And you're hearing more and more about machine learning and automated appraisals and all that. And that's where I start to get a little nervous about making some mistakes, because at the end of the day, commercial real estate is not like a stock where you can run models based on 5 or 6 metrics and look at some historical charts and speculate. The same identical real estate across the street from one another built the same day 10 years ago could be completely different investments and have different values depending on the way that they've been run, as you well know. So that's where I think that human component of the appraisal side, along with a lot of facilitation by technology, but man,
I think generally speaking, this has been and always will be a between the ears business, right? You can't write an algorithm to do what you can.
It can facilitate.
It can facilitate it, but it doesn't replace it.
Right.
So, other questions?
Great question.
But
Thanks.
by the way, appraisals, from a finance side, you probably see them as well. I mean, there is such demand now for appraisers that it's taking 2, 3, 4 weeks to get an appraisal, where you could do it in a week and a half, 2 weeks. I mean, they could turn these things over. There's so many transactions taking place either on the finance side or the sales side. It's difficult to get an appraisal these days.
Right. No, there's a backlog.
There's a backlog, yeah. So, yes, sir.
Sure, happy to, Daniel. The question is about rent collections by class, where we are seeing very strong rent collections in the Class A space for multifamily, but not so much on the Bs and Cs. And it is true that professionally managed apartments have done very well throughout the pandemic. They work with the tenants, and through the whole eviction moratorium and all that, and they perform extremely well. Smaller owners and B and C owners have had a more challenging time because there's been more distress at those service-oriented jobs, especially in the initial stages of the pandemic, the restaurant jobs and the hospitality jobs and so on. Whereas a lot of the Class A tenant base is professional adults that have more office-using jobs than they do direct service jobs. But I think we're starting to see it bottom out and come off, especially as the restaurants came back and hotels came back. There's a direct correlation between those, and now we're hitting a little bit of a speed bump again, just like the labor market. I mean, we only added 250,000 jobs last month, and we should be adding 800 to 900,000 jobs a month. It's only because of the variant. But Daniel, I'm really glad you asked the question, because in the B and C space, there literally is no new product. So there is such a scarcity of inventory that we're not concerned at all about those fundamentals. Rent growth is still very strong and should remain strong. If anything, at the macro level, we need to do a better job between private and public partnership to create more affordable housing.
Yeah, I mean,
it is the obstacle.
You talked about value add or conversions or reuse.
Yep.
Right, I've seen a number of these now where you're taking a lower end, motel, hotel and converting that to workforce housing.
Yeah.
The plumbing's there, the rooms are there, because it's much more efficient to do that than it is to try to build it ground up. Cost of land, cost of labor, cost of materials, same thing.
Absolutely.
So I think people are getting creative in that to try to create this housing, especially affordable housing,
right,
which there's a lack of in most markets.
You just jogged a memory. Our hospitality division, I was just with them over the weekend in D.C. Some of our top agents were with me, and they were talking about assignments they've gotten from various cities to help them acquire hotels to address the homelessness issue in some of the urban markets.
Yeah,
so a lot of the cities are our clients at this point, wanting to buy assets on the buy side.
Maybe you buy those and convert them to SROs.
Yeah, right.
Yeah, interesting.
The world's changing.
Even
if
you don't adapt, you will die. Any other questions for Hessam? Well, with that, we're going to take a break for 15 minutes. We'll be back at 10:45, for the capital markets panel. And appreciate you all being here. Hessam.
Thanks for having me on.
It's been a pleasure.
Great to be with you. Thanks a lot. Thank you.